how you doing today? Scott Kidd, the Yacht Captain Investor podcast, where we strongly suggest you invest in yourself. That's your best investment. I have today with my good friend Raj. He is a multifamily syndicator, also owns a marketing business for real estate investors. How you doing today, Raj?
Hi, Scott. Thanks so much for having me on your podcast. We have known each other for a couple of years at least,
Yeah.
but it's good to come on your podcast finally.
Well, thank you. I'm glad to have you, and thank you for your time. Just for people that don't know you, just tell us a little bit about yourself.
Yes, so I live in Houston, Texas. I'm actually a physician by trade, and that's my first passion. But I also started investing in real estate about 10 years ago and got into multifamily investing. So that is my main focus. I help other doctors, especially invest in multifamily apartments. And as you alluded to, I also, as part of this process, learned a lot about marketing. And then now I have a company called Redoc Agency where we help other real estate investors market their deals, syndications, get new investors, leads, etc.
Oh, okay, that's great. I know, and that has grown, and we'll talk a little more about that later on, because I know that's a big part of what we do in the real estate world, the marketing side of it. So what are you working on currently?
So we just launched a deal in San Antonio, Texas. It's a 127 unit multifamily apartment, Class B, built in 1985. So what happened is when I first started in multifamily real estate, there used to be like a lot of bridge loans. As you know, a lot of apartments got into trouble or still in trouble. So we actually acquired an apartment in Houston last year. It's called Candle Ridge. It's like 134, not a very big apartment. But our plan there is we got a Fannie Mae fixed rate loan, and it was already cash flowing from day one. We already did 2 distributions in that apartment. So far, everything is going well. So we basically copied that model, and then we found another apartment almost similar. There was 134, this is 127 unit. This is 1985 built. That was 1984 built. Same story, more cash flow from day one. Unfortunately, the seller is distressed.
Oh.
So not the apartment itself, but what I mean by that is this seller has like 2,000 units in San Antonio. And a couple of their apartment complexes are not doing well. Our best guess is that the same lender is for multiple apartment complexes, and they call the loan on all loans. So the seller is being forced to sell this apartment. And we came there on the right time. And then we are actually buying it they purchased only in February 2024. And we are actually buying it $2 million less than their purchase price.
Wow.
Less than a year later, right? So the price is right. They already did a lot of the renovations for the apartment. The exterior is completely painted. They improved the office, pool area, etc. So we don't have to do a lot of capital improvements, which they already did. So our basic business plan is a very boring business plan. Buy the apartment. Of course, when the tenants leave, fix the units. And other than that, good management. And then cash flow for our investors.
That sounds really good. Are you seeing more distress in the Houston market with deals like these? I see that you're saying that the seller is under some financial distress. Are you seeing stuff like that? I'm seeing some of that come around. Are you seeing that more in the Houston market?
In Texas, for sure, we are seeing more and more stuff because, as you know, people in general stay till 2025, survive till 2025, and initially everyone thought the interest rate is going to come down in 2024. Yes. It didn't. Then they said, okay, interest rate will come down in 2025. It didn't. So a lot of people now with the tariff and everything, actually the interest rate is going back up again.
Yes.
And a lot of people who were holding on to their thing, now they think, okay, it's no longer possible. And
yes.
The loan companies are more open to taking the loan back or calling the loan.
Yes.
So we do see a lot more distressed properties coming on the market, and I don't think it's going to slow down anytime soon.
No, yeah. I would agree. I think I see more of it coming because they've already restructured, and the bank may not want to keep restructuring because they're probably have a lot more additional costs there. And so were you getting it $2 million underneath the purchase price, or $2 million under the original mortgage, or was that just equity that got lost by the
No, it's a purchase price. They have a mortgage for $10.1 million
okay.
on the property, and we're buying it for 10.75. So you can see that once they sell it, they're probably going to pay the mortgage off, but nothing is left after that.
Okay, so the equity is wiped out
Yeah.
from their investors or something.
Yeah, unfortunate for the investors, and of course we don't know exactly how much the seller paid because Texas is a non-disclosure state.
Okay.
So it was listed on the market for 13.4.
Okay.
We assume they got it on a little bit of discount, but we're paying for 10.7. So you can see there, like at least there is like $2 million less than potentially what they paid for the apartment. Yeah.
Okay, so you said 10.7, and it's 127 units. What's that,
it's
about
like
roughly
$86,000 per unit.
86 per unit. Oh, that's
Class B. It's a pretty good thing.
It's quite good. And is it a B plus area where you don't have to do a lot of repair or anything on turnover?
Yes. So that's what we're going to do. Plus, there are some units which could be upgraded. But the thing is, we don't think we'll get the rent bump. So we are not going to unnecessarily spend $10 in the unit if you're not going to get a good rent bump.
Yes.
It is cash flowing as it is, so there is no reason to appreciation right now. Right. So
what we have done in some areas, you do a couple of test units, you do maybe one or two, see if you get a little bit more. But if you're seeing a little more distress, more than likely you won't get the rent bump anyway. You'll probably just have to clean it up, paint, and
yes, similar to other areas in Texas, as you know. Texas has an oversupply of apartments.
Yes.
Because during COVID, everyone was moving into Texas. The rents were going 10% a year. So everyone got excited. Austin is the number one market for oversupply, but San Antonio also has oversupply of the thing.
Yeah.
The one we are buying has currently 90% occupied. We want to maintain that. At some point, the apartment construction has completely stopped.
Yes.
So next year or year after, the supply is going to go off. Then we can think about, hey, okay, now the rent is bumping up, so let's renovate some units, even get a higher bump. But right now we want to maintain the occupancy.
Yeah, if you're at 90% occupancy, they say if you're at around 93, you're fully stabilized pretty much. But if you're over that, then your rents could probably be bumped up. But at that point, you're probably going to have to stay. And I know in Dallas, in particular, there were a lot of units that came online in North Dallas, but it seems a lot of them got absorbed. The absorption rate was very high there. Austin, I know they haven't gotten absorbed yet, but people are still moving there, and I know Houston as well. Plus, you're seeing, like we were just discussing, the restructuring and stuff they've already done that, and they may not want to do another round. And then you're also seeing, which is interesting, that people that own, say, 2,000 units, they're in financial distress because maybe one or two properties that are doing so bad that they're, hurting them pretty well. And it's, Houston is, since real estate is local, Houston's a much different market than San Antonio, Dallas, and Austin. That's a whole different, everyone during COVID, a lot of people from all over the place, New York, California, moved there because it was relatively cheap compared to what they were.
The one difference in Houston market is it's a relatively boring market.
Yeah.
It's never too high, never too low.
Too low, yeah.
Usually in the middle. The occupancy is always in the 90% range. It doesn't go to 100%, but it also doesn't go down too much as well. But of course, Houston, the issue is insurance.
Yes.
The insurance rates have been going up, so you have to take that into account. Other than that, Houston is a boring market. Like they didn't build out that much in Houston and compared to Austin, San Antonio, Dallas.
Yes.
But at the same time, we have to make sure the insurance rate stays, the underwrite
stabilizes.
Insurance.
I know because of the storms. I know if you get north of Dallas, the insurance rates get a little more favorable. How are things on property taxes and stuff? I know taxes can be an issue as well sometimes.
So Texas is always, because we don't have income tax, so property tax is higher.
Yes.
Our expense ratio goes up. It is what it is, so we write it up. There are other advantages in Texas where the
Yeah.
cost are low, labor cost is low. So we
Yes.
always write that in our underwriting, property tax. For this property we are acquiring right now, it's actually assessed by the San Antonio assessment district up to 11.5 million, and we are getting it for 10.7. So day one, we are going to show, hey, we pay 10.7. So we're going to get the property tax reduction for about $800,000. Right?
Oh, wow.
So for the $800,000 of assessment, we can get reduction in that.
Oh, okay. Well, that's great because that would probably be about 16,000 a year, something like that.
Yeah, about It's like
roughly 2% ish, depending on
5% tax, property tax. So that's
a great savings.
Yeah.
Yeah.
So that one, when compared to the current cash flow, it's already cash flowing. So we're saying some more cash based on that. Our insurance, we are getting a better deal than the current seller has. I don't know why the seller is paying a lot of money, but we investigated it a lot. We actually going to pay like $800 less per door than what the seller is paying per year.
Oh, wow.
So that's again a savings we can translate to our investors stuff. So it's of course each property is going to be different.
Yeah, and you have to have a very good agent with stuff like that. Especially being in Houston, you have to shop around and find somebody that's good.
This one I was talking about San Antonio, the property, but it's not as high as Houston because it's inland.
Yeah.
Less risk of hurricane. But we used our broker and then we shopped around and then we got a better quote.
Yeah, and I know with Houston, with the insurance being the way it is, I know that the price per door has kind of moderated a little bit, I guess, because there hasn't been a storm for a few years or a couple of years. But I know hurricane season is coming up, which it seems like, I talked to a lot of people in a lot of other areas. The insurance companies didn't just hit it in Texas and Houston and Florida. They kind of spread it around because you had those other issues in North Carolina and in New England and all throughout. It's something you always have to take into account. So, switching gears a little bit, what made you decide to start doing some more, starting your own marketing agency for real estate investors?
So this basically started when I was in this raising capital for real estate deals. I started learning about marketing, right? So I'm a physician. I didn't have any background in marketing. I never thought about marketing.
Yeah,
it was very fascinating, but I was forced to learn for my own company. Yes. And then I saw that there was a deficit in the market. So I was using software called Active Campaign. A lot of people use it. Yes. And most of these services, when you're starting out, they bait you with a very low cost. Mm-hmm. And then as you're growing, they will keep expanding the money you have to pay for their service.
Yes.
Right. And so that one was frustrating for me. So we founded an agency where we offer a white label software on a system called Go High Level. So we offer a fixed price for our clients. So they can have 100,000 contacts as the same price. They can have as many users as they want as the same price. So it's like from day one to day whatever, the price stays the same. So that gives them stability for the business. They don't have to think about, hey, do I need to bring in more leads? I'm not going to pay more money for it. And it's also, the other thing I noticed is we had to use like 10 different softwares for 10 different systems. One system for social media, one system for CRM, one system for website hosting, etc. But our system everything is in one place. It's one login. You go in there, you can do everything needed. It saves you a lot of money because you're not subscribing to 10 different systems, and also saves you a lot of time. So you're not figuring out how to integrate all these things. They work seamlessly. So a lot of the real estate investors, they are not interested in technology. That's not the core of the business. Core of the business is serving the customers, managing the properties. So we wanted to take away that pain point from them where they had to spend time learning about technology and making sure things are working well. So we do that on the back end for them so that they can concentrate on their core business. And I enjoy it. A lot of people don't enjoy it. I enjoy the technical side of things. So that's why I do it. If I don't enjoy it, I will not be doing it.
Of course.
I like to learn new things and then see how it works. So anytime I learn a new thing, I actually apply in my own business, because I'm also in multifamily real estate business, and I apply in my own company, make sure it works, then I offer it to my clients. So that's also gives them an extra value, because I have already tested it. I understand the real estate business very well, so they can rely on me to tell them what works, what's not working. So that is the other advantage they have when they're a client for me from my company.
I see. Yeah, I had a similar path as well. I had all these different softwares where I didn't. A lot of them didn't work together, and so you spent time on this one, then on that one, and you couldn't really just jump back together. And it is a big pain point, especially in any type of marketing system. And for the most part, I would imagine people use it a lot for just keeping in contact with their investors and their CRM and raising capital and stuff like that. It seems to have become very, very popular. What do you see like with AI integration and stuff like that? What are you seeing there? Is some of this stuff going to be, some of the tools become obsolete, or is it just going to enhance these tools?
So for AI, for sure, is going to enhance stuff, right? It's going to make us more efficient, but it's not going to replace one-on-one relationship for raising capital, right? You still have to talk to people, but AI will help. Before you talk to people, you have to generate leads, you have to nurture them, right? Before they book a phone call. So the AI is going to help with that. So you spend less time generating leads, less time making copies for your post, those kinds of things, writing email newsletters. Even now, what I do is I write the core of what I want to convey message and use AI to enhance it. Right? It polishes it better than what I would do. Right? If I dictate the core message, I don't even type it, and then give it to AI, say, hey, can you expand on it message? So it saves time, and we use a lot of automation and AI for our own business. For example, we have a 24-hour phone call agent. So if someone calls our company, the AI is going to talk to them.
Oh, okay.
We don't deceive them. We don't tell them that it's a real person, even though if you don't tell them, they won't be able to differentiate whether it's a real person or not. So my AI agent, first thing she says is, hey, I'm Sally, I'm an AI assistant. How can I help you? So that people know that they're talking to an AI person.
I think there will probably be some legalities that will probably come out that you have to disclose that you're speaking to.
Right now, for inbound calling, there is no legality, but you cannot use AI to call someone. Outbound, there is some legal regulations coming up. So we don't use it for outbound. We use it for inbound calling, but we disclose because it's the right thing to do. Right? Don't want to be deceived by agent,
because they are quite good, because I know we've played around with it quite a bit, and they are quite good, and they will solve probably 90% of the requests until you get to a certain point, and then you need somebody to go through and finalize, do some Q&A and stuff like that, which I see your point where you use the software to get your leads. I know you need to have at least 12 to 14 touches before someone will want to engage with you. So you can bridge that gap by, with social media, emails, with the other types of things, that you can use to bridge that gap and speed up that process a little bit, because they really have to know who you are. And I know there's a 7-11-4 mantra that says, I think you need 7 hours of content, 11 different types, and then on 4 different platforms before someone will engage with you and go, oh, okay, this is a legitimate one. I guess that you're a legitimate person, because with AI and stuff, like you said, it's good that you qualify that, because you don't want to mislead anyone. And where do you see like, as far as, because I know raising capital right now, a lot of people, with everything going on with a lot of different things, people are very hesitant with a lot of things. What are you seeing going forward?
So I haven't actually launched. We launched the deal right now. So webinar is next week. I have 61 people signed up. So that's the largest I've signed up.
Oh, wow.
So there is a lot of interest. So I think with all the things going on in the stock market, personally, we are seeing, at least for the deal, my partners and I have seen more interest.
Yes.
Because they're like, oh, the stock market is going up and down. It's causing heartache every day. So they want something very stable, which is what this one offers. It's a cash flow. It's
from day
5
one.
years. regardless of who is on the White House, it's
Yeah.
for 5 years, it's a
Yeah.
stable investment. I think it's so far it's working out well.
Yeah.
Of course, I'm also looking at the bond market. We don't want
Yes.
it to the treasury 10-year treasury
If
note
it
to go
goes too
high,
high, then that becomes
then it's going to be
competition.
a problem for real estate. Not only real estate, everything. It's going to be a problem for every business. So
Yes.
that's one of the things we are closely looking at. We are hoping it will stabilize. We are already underwritten for that, but I think it's a long-term game. So people who are looking for long-term investment, real estate is still the right place to go. Yeah.
Yes, I would agree. You know, what I tell a lot of investors and just people that are inquiring about real estate anyways, like, look, all of these multifamily syndications or commercial syndications, most of them are going to outlast all the people that are going to be in the president and that's going to be president or in Congress. You know, it's a long-term thing because you want your money to work long-term. You don't want it to be a short-term because then that becomes more like gambling, you know, and I think there is a lot of hesitating, but that's good news that people are a lot more interested now. You know, and you can share the link with me a little bit later, and we can put that in the show notes. So if people want to take a look at it, because I know you'll probably record it as well, and then have it available for everyone.
Great. Yeah.
And that's it. That's in Houston and 127 years. Oh, it sounds.
Sorry, San Antonio.
Oh, San Antonio. Okay.
Yeah,
So
the one we are doing right now is San Antonio. The one we did last year was in Houston.
okay. So no, that's great that you're looking at stabilized deals, because that's what we've been looking at, and since moved into development and stuff, which is going to be a longer road. I like the longer vision. And it seems like that's where you are as well, because the value add stuff can get stalled out now. There's even some more question marks with labor, and materials and stuff are going to be, we're not really sure, especially where the lumber and all these other materials are coming from. It could be much larger prices that we don't know, and I know all markets like stability. So as far as like for the rest of this year, what are you looking at? Are you looking at more deals as well, or mostly Houston?
So we always look for good opportunities, but we do 2 deals a year, maximum 3. We don't want to do more than that.
Okay.
So previously I used to raise capital for other people's deals. I stopped doing that anymore because I have less control. So I found a stable partner right now, and we are working together. So I have more control over what happens, more say what happens. But our philosophy is the same thing. Look for boring investments.
Yes.
There's not a lot of excitement. You don't have to have a lot of value add. But at the same time, look for cash flowing investments. And then we're not in a hurry to close on deals. So it's probably this year, this is one deal. We'll probably do one more. That's it. We're looking for, but we want, whatever deal we acquire, we want to make sure it's good, we maintain it properly, do the things we promise we'll do, and then give the cash flow back to the investors. So we are not looking to do many deals, probably 2, maximum 3 per year.
Yeah, it's much easier to manage and focus on one thing at a time, and especially you can service the residents and the investors, which it's all about the residents and the investors. If the residents are happy, the investors will be happy, because those residents will stick around and stay. Well, this has been really great. I know you have other commitments. If people want to get a hold of you, how would they find you?
So the best way to find me on LinkedIn, if you go to LinkedIn and put my name, it's Rajkumar Venkatramani, or you can put in REI Doc, the one.
Going right behind you.
Then you'll find me there, or you can email me at raj@redoccapital.com. That's my thing, raj@redoccapital.com. So yeah, I'm happy to talk to anyone, and always happy to make new connections.
And where will your deal be? Will that be posted on your REI doc for next week if somebody wants to find it?
The name of the apartment is called Stratton Park.
Okay.
I will send you the link. It's redoccapital.com/Stratton. If they go there, they can see, but it's all over my social media. If they go to my LinkedIn profile, it's on top of there.
It's going to be there.
My Facebook, it's there. It's easy to find. But the best way is if they contact me, I'm happy to send them a link as well.
Okay, perfect. Well, this has been great. I really appreciate you coming and taking the time to speak to me today. This has been really good, and I'm sure we'll be doing it again.
Thanks, Scott. Thanks for what you do. I know you are very, I remember, you are very helpful. Your Facebook group The one thing I want to point out is there was some guy from a Facebook group contacting me, and I alerted you. I said, "Oh," you said, "That's fine. He's a nice guy. Let him." So you said so like giving and open-minded. So that's
Well,
good.
thank you. Yeah, because this is what I really like about multifamily and commercial real estate. We all help each other. There's a lot of people that are givers because it's a team sport. And if I can help you today, maybe we can all help each other, later down the line. And it doesn't really matter what you get in return, because if you get something in return, or you think you're going to get something in return, it's transactional. It's not a real relationship. But I really appreciate you being here. Thank you so much.
See you.
And that's the Yacht Captain Investor podcast out. And just another reminder, invest in yourself. That's the best investment you can ever make. Thank you.